Hi everyone, thank you for watching this video. I would like to share about understanding the pool investment. Pool investment vehicles including the mutual funds, hedge funds, and ETF offer the investor access to professional management and diversification. These funds issue securities like shares, units, or partnership interests. Lead plan setting, share ownership in the underlying asset. By pooling resources, investors can tap into expert and opportunities that might be inaccessible individually. This presentation provides a comprehensive overview of these investment vehicles, their structures, and their unique characteristics. We will discuss how these funds operate, their advantage, and key consideration for investor. Mutual funds, open-end versus the closed-end. Open-end funds. This fund issues the new shares and redeem the existing one on demand. Typically is daily. The price is based on the fund's net asset value per share. Investors transact directly with the fund, buy and sell shares at the current NAV. Closed-end fund issue a fixed number of shares and initial offering. After that, investors track the shares on the secondary market. Share price can differ from the NAV, often trading at a discount due to expenses or investor sentiment. ETF and ETNs trading at net asset value. Exchange traded funds and exchange traded notes are open-end funds traded on secondary market. A key feature is their price alignment with net asset value. Authorized participants play a weaker role. When ETF price dip below NAV, APs buy shares and redeem them with the fund at NAV, profit from the difference. Conversely, when ETF price rise above NAV, APs buy shares from the fund at NAV and sell them on the market. These arbitrage mechanisms keep market price closely aligned with NAV. This is a major difference from closed-end funds. If price below NAV, APs buy the share. Redeem with funds, APs redeem the share at net asset value. Profit. APs profit from difference. In-kind transaction and depositor. Many ETF facilitate in-kind transaction instead of cash. Buyers deposit a portfolio of securities with the fund, receiving shares in return. Likewise, sellers receive a portfolio of securities when redeeming shares. This portfolio mirrors the fund's holding. These funds are sometimes called deposit. As this issue deposit receipt for deposit portfolio, trade in the secondary market. This structure is also used for tradable warehouse receipt for commodities. Portfolio of securities. Deposit with fund. Receive the share. Asset-backed securities. Asset-backed securities derive their value and income from a pool of underlying assets such as mortgage, credit card, debt, or auto loans. These securities distribute interest and principal payments from the asset pool to holders, typically monthly. The payment structure may involve transaction where some classes of securities have priority over in received payments. This is often used to control the risk. Senior tranche, high priority. Mezzanine tranche, medium priority. equity trends lowers the priority. Hedge fund win new initiations. This generous father manager partner managing and attends a portfolio of assets. Hedge fund limited partnership. Hedge funds are investment funds typically structured as a limited partnership. Hedge fund managers act as a general partners, while qualified investors are limited partners. These investors must meet specific wealth and knowledge criteria to participate, acknowledge the risks of substantial losses. Regulation vary by jurisdiction, and hedge funds employ diverse strategies. Funds that are generally organized as limited partnerships are called hedge funds. Qualified investor, the wealthy individual or institution. Diversified strategies, long or short equity, arbitrage, performance fee, incentive-based compensation. The hedge fund compensation and leverage. Defining characteristics of hedge fund is their compensation structures. Managers receive an annual fees based on asset under management, plus a performance fees tied to the fund's investment gains. Many hedge funds use leverage to amplify returns and risks. While not universal, leverage is a common tool to enhance exposure. 2 and 20 typical fee structure. 2 times leverage may increase the returns. The key takeaways on pool investment. Pool investment vehicles